Welcome to clients of Nigel and the team at Just Financial. My name is Mark Jordan, and joining me today we have Alan Pullen, Portfolio Manager here at Magellan. Welcome, Alan.
Thanks for having me.
I'll start off with a question, I suppose, around some of the risks that we're seeing at the moment. And as always, Magellan is conscious of watching the risks and events around the world. One that's gained a little bit more prominence in the last 12 months is China. We've seen the Evergrande property group near collapse. And we've also seen the government there, the CCP, increase their regulatory process around many businesses. How do you view it, and what are we doing differently at the moment?
Yeah, no, it's a good question and very much at the forefront of investment at the moment and how we're thinking about global markets. So I think it's important to take a step back first and think about why we're investing in China in the first place. And if we look at GDP per capita there, it's around $15,000 per person, compared to around 55,000 in developed markets. So places like Australia, the US, Singapore. So they've obviously got a tremendously long way to go in terms of economic growth to catch up to those more developed markets, or even just to get closer to developed markets levels. We know they're really good at exporting. Where this growth is going to come from is consumption. They're trying to shift the economy to more an internal consumption-driven economy. And that's a tremendous tailwind of growth to businesses that serve those local consumers in China. So it's a very attractive long-term tailwind, which is why we're interested in China in the first place as an investment destination. But you're absolutely right. It does come with different risks to investing in the US and Australia. And we've seen some of those manifest over the last year. I think it's worth dividing those risks up into a couple of different categories. One, we've got economic risk. Obviously, you mentioned Evergrande. The property sector has been a pretty important driver of growth in China over the last 20 years or so, and it's become outsized part of that economy. Now, the government does want to rein in the growth in that property sector. They think it's unsustainable, and they see it as a risk. As we've seen property sector cause downturns in the West, they're worried it would happen there. I think what's an important distinction that we need to make is this is being driven by authorities. They are deliberately trying to get Evergrande to implode, but in a controlled fashion. They do not want the entire economy to implode. They do want to slow the property sector, and that's how they're going about it. So we think it's controlled at this case. There are elevated risks around that, and we would expect growth to slow down a little bit because of the slowing property sector, but we do not think it's out of control at this stage. So it's a risk worth facing, but we think the government, if they wanted to inject liquidity into the sector, could protect against that downside. But it is an elevated risk, and it's something we do need to take into account when we're thinking about China exposure. The other risks you touched on there, which are definitely coming to the forefront, is regulatory risk. And it's coming in a couple of different fashions there. You've got regulatory risk around tech platforms, around data privacy, around competition. And they're kind of similar to some of the issues we're seeing in Western companies, all right, where people getting investigations into Apple, into Google, into Facebook. So it's not that dissimilar, although the CCP, the Chinese Communist Party, obviously can move a lot faster than Western regulators can. So it's certainly an elevated risk. And there's another risk there which is quite specific to China in terms of their social policy risk. They are implementing social policies to kind of meet the goals of the Communist Party. And that includes like the crackdown in the education sector that we saw. That was because they thought education was getting too expensive and making it people have less children, and they worried about the demographics. So they cracked down very quickly there. And that was obviously, for those investors in education companies, which happily wasn't us, was a big risk for them. So those risks have become more elevated. We've seen them take more action against kind of tech companies, against other parts of the domestic economy to achieve the goals of the China Communist Party. What does that mean for us? Well, it does mean risks are elevated. It's certainly different to investing in the US. It's different to investing in Australia. And we need to be mindful of that. There is this very attractive long-term opportunity, long-term growth, but it comes with these elevated risks. So we've got to seek to understand them as much as we can and really make sure we take an appropriate risk management perspective to that part of the portfolio. And we've done that kind of over the last year or so, as these risks have risen, we've actually decreased the weight of the exposure to China. We've differentiated. Our two big direct investments there were Tencent and Alibaba. We think Alibaba is probably safer than Tencent because they're involved in e-commerce and cloud computing. They're not likely to be at the forefront of regulatory crackdowns going forward. They have already had some, and they're no means completely out of the water. But probably Tencent, which has got a big gaming component, is probably more at risk there, given that gaming monetization can be a sort of gambling. It's hard to think of gaming as really advancing kind of the society that the Chinese CCP is trying to deliver. So we've actually completely exited Tencent. We're taking a nuanced approach. We still think, Alibaba can plan that attractive long-term growth, but we've reduced the overall size of that exposure there. There is another way, of course, to invest in China, and that is through global companies who have strong Chinese local businesses. Starbucks has a very strongly growing Chinese business. LVMH has a strongly growing Chinese business. They come with different risks. So they come with some geopolitical risks potentially. If the Chinese gets into a disagreement with a foreign country, the companies from that country could obviously be impacted. We've seen a bit of that in Australia, of course, over the last year. So that's a different way to play that, but comes with its own risk. And again, we're thinking about the aggregate of our China exposure. We have some companies, such as LVMH and Starbucks, who are exposed to the geopolitical risk. Domestically, Alibaba, a more modest position than we used to have, just given the elevated risk there. So trying to take a nuanced exposure with that really long-term attractive growth versus the elevated risks on the other side.
Moving to, I guess, broader markets, over the last 12 months, we've seen global share markets rally extremely strongly following the really positive vaccine announcements that occurred back in November. In that same 12 months period, the Magellan Global strategy has not performed in line with global markets. Mm-hmm. We've seen a bit of a gap in the relative performance. Could you perhaps address that and talk around the reasons why that's the case?
Yeah, of course. First of all, going back to our objectives, the first objective is downside protection. We want to make sure in down markets that we do significantly better than the markets overall. And part of the way we do that is typically we have about half of the portfolio in very defensive investments, consumer staples, infrastructure companies, and cash all kind of make up that really defensive part of the portfolio. Now, when markets go down, they tend to be much more resilient, and they give us that downside protection, which is one of our main objectives. Of course, the other objective is to achieve 9% after fees through the cycle, which we think will be a really attractive compounding return for investors over time. And while we have achieved that over the past year, the market has just been so strong we are well below the market returns over the last year. So the first part, we have a look at this, and the first part is really about that defensive portfolio. Once we had the vaccines come through as being so effective, much more than kind of anybody anticipated at the time, we saw a really strong rally in global markets. And of course, that was concentrated in some of those more speculative stocks, some of those stocks that really rely on macroeconomic activity to give them a boost. And so we saw those stocks perform really, really well, and people tilted away from those defensive stocks, which, they don't go down when the economy is bad, but they don't tend to go up as much when the economy is going really well. And with about half our portfolio in those really safe stocks, that was actually the majority of the underperformance kind of over that period you're talking about. The other big factor was China. We did have two big positions in Tencent and Alibaba, which cost a significant amount of performance over the past year, as we just talked about those regulatory issues coming to the fore. Those, with hindsight, were perhaps two bigger positions. They had had a very good year the year before last, and they'd probably grown to too large in the portfolio. And they did cost us some performance. We think we've recalibrated the size of that exposure sensibly, but it certainly did have an impact over the last year.
Now, that's all been looking at what's happened in the past 12 months. Now, as investors, it's important for us to be looking out the windscreen rather than looking in the rearview mirror. How's the portfolio currently positioned, and what's the outlook for some of the stocks that we hold in the portfolio?
That's a good question. Obviously, that's what is important to all investors. We're a little bit cautious on the market overall, I should say, looking forward. We look at where valuations are today. They're certainly a little bit elevated prior to history, relative to history. And when we look at past returns, we've had a big tailwind over the past 20 years as interest rates have declined over time, which has been good for market valuations. Looking forward, you can all see interest rates are such a low level. There's only really one direction they can go going forward, and that's probably going up at some point over the next 10 years, say. That's going to be a headwind to performance in terms of equity markets. So when we think about equity markets as a whole, we probably think about a 6% return is what they'll probably deliver looking forward over a longer time frame, not a one-year time frame. We're talking about an average over an economic cycle. Having said that, when I look at the portfolio, we are still seeing some really good opportunities to deliver on our objectives in terms of defensiveness and that attractive 9% compound return over time. And the first part of that is that defensive part of the portfolio, which is half the portfolio. As I said, with the strong rally in economic activity, we've seen the market kind of bid up some of those more speculative stocks exposed to growth or cyclicals, and we actually see the defensive part of the portfolio as relatively reasonably valued at the moment. Of course, it's not going to deliver 20 or 30% like we've seen, but in terms of delivering that compound 9% type return over time, I think they're set to do that. We're seeing some pretty good valuations with a lot of downside protection and very low risk in that part of the portfolio. The other important aspect, of course, is some of our structural growth stocks. We're still seeing opportunities to find stocks with, notwithstanding slightly slower GDP growth going forward, with really strong underlying fundamentals. And we don't invest in the whole world. We invest in 20 or 25 so stocks of incredible quality, and we're finding some with some really attractive growth prospects still today in this market, which can really give us the confidence that over time we can deliver those kind of compound returns. Let me just talk about a couple of them. Microsoft is one we've invested in for a long time. We first bought that 7 years ago, and I think it was $27 a share. It's currently over $300 per share. So it's been an incredible return for investors, and a lot of fund managers would have kind of taken their gains and sold out. But that's not what we do. We look for these quality compounding stocks and we hold them for the long term. And we still see that Microsoft is in the middle innings of really its compound growth. When we look forward, we see them continuing to deliver revenue growth of 10% per annum going forward. And they are really dominant in a couple of really strong sectors of the economy. Hyperscale cloud is still in an early stage of adoption. All the world's computing is going to go from kind of on-premise to these hyperscale cloud providers. And Azure, Microsoft's business, is the second largest provider there. We also have exposure through Amazon to AWS, the number one, and Google owns the number 3 provider as well. So we've got strong exposure to this, and we think it's going to be a huge revenue grower going forward. Microsoft, as we know, also dominant in office productivity, their Office suite. They're a leader in security as well. So all these are really attractive growth markets. And when we look at that company, we think about 50% of their market cap, their revenue, is currently exposed to the cloud. And that's going to grow at 15% compound for a decade. So notwithstanding that it's already a very large company with $170 billion in revenue, last quarter it grew revenue another 20% year on year. And we think it's going to grow at 15% going forward. So that's going to deliver huge returns, compound returns for investors. So one we've owned for a while, but as I say, you find a quality company, grow up with tailwinds behind it and stick with it, and you get really good compound returns for investors. That's one we've owned for a while. So what about a newer stock? Well, Netflix is one we think is in an earlier innings, kind of in that growth phenomenon. They have 200 million subscribers now, but when you look at pay TV subscribers worldwide, there's over 750 million today. And that pay TV ecosystem, it's challenged because they are losing subscribers. People are cutting the cord. And when they do that, they have less money to spend on content. So their product gets worse. And what does that mean? More people cut and they come across to the streaming services. And Netflix is the global leader there. So they're investing more in content than anybody else, $20 billion in the past year alone. And that is deriving a superior product that's going to get more and more people coming on board, more money to invest in content, and they're going to continue to grow strongly. We saw the phenomenon of Squid Game just this year. If you haven't watched it, get out and watch it. It's very good. But what's remarkable is that this is a small, kind of relatively small production out of Korea, which they've managed to monetize on a global scale. So not only is Netflix attractive to consumers because they get a really good service and great content, it's actually really attractive for producers because before these content creators, they didn't have a platform to take a small show from one geography and distribute it to the world and have a chance for real success that way. So they're bringing together this platform of content creators and consumers into an incredibly powerful business model. So that's going to continue to compound over time. And when we take some relatively unaggressive numbers, we assume by 2030 they get to 400 million subscribers. As I said, there's already 750 million people paying for pay TV, and this is a considerably cheaper product, even assuming people take one or two or three streaming services. And we assume that they can grow their pricing at 6% a year. That's historically, by the way, what pay TV has got. But as you can see, Netflix is getting better and better content each year, as we said. So we think that's very sustainable as well. On that basis, they'll have $100 billion in revenue by 2030, and we estimate earnings before tax could be in the order of $50 billion as well. So, that suggests that could easily be $1 trillion company, which is 15% plus returns for shareholders from today. So still some really attractive opportunities out there when you're able to select the highest quality companies in the world.
We'll look forward to watching that play out. But thanks, Al, for your time today.
Thank you very much.
So just in summary, as a reminder about what the Magellan strategy is set to achieve, we are patient long-term investors. We invest in some of the highest quality businesses in the world. The objectives of the fund are to deliver a return through the cycle after fees of 9% per annum. And alongside that, it's to ensure that we provide a level of capital protection in down markets. Thank you for watching today. If you have any questions, please contact Nigel and the team at Just Financial, and I'm sure that they'll be able to answer them for you. Thank you.